Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I want to discuss Visa. Is this undervalued? Should we invest in it now? You're going to want to watch this video. We have in their website, their investors relation, and they talk about how they've added 18% revenue from different services that they've added in the past. And they have on their website a great video that discusses how they make money. So one misconception that people have, they believe that when they get a Visa card, that they're getting credit from Visa. So the good thing for Visa is that they don't have none of the risks that comes with lending money out. They don't lend money out. They don't make money on interest. They're kind of like the middle person, and they facilitate the charges and the processing of the purchases. And how they make their money, they divide it into service revenue, data processing revenue, and international transaction revenue. So you see here, they are trying to expand and get into other things, been on an island by themselves. And since their IPO, they've grown over 500% as far as their stock price. They've done extremely well, but there's more competition now. There's more scrutiny with their charges being too high. So they definitely have to look into other means to make revenue. So if we look at their revenue from 2012, 11 billion, and just growing every year, growing 1 or 2 million, growing, all the way up to 24 billion. And the great thing about Visa is their direct cost to make this revenue is extremely low. So you see here, 21 billion revenue, only 727 of cost of revenue. So they keep 21 billion. And then their indirect cost too is not too bad. I mean, 6 billion for selling, general, and admin, and it comes down to 14 million. So they do use their money to invest in other ventures. You see that they've expanded their services. They do buy back some of their shares. You see here, they started off with 2.6 million and now down to 2.1. You know, not exactly a whole lot, I'm sure, but they do buy back some of their shares. They do pay dividend. And I want to just take a quick look at some ratios just to, build a case. And these ratios, when they stand by themselves, they don't mean anything. And even the use of them, some people like to use them, some people don't. I just want to build a story. And when I'm talking about Visa, it's not like a high risk growth stock. It's a company that's been established. So I want to decide, am I getting a good value? Am I paying 75 cents for $1 or 60 cents for $1? That's all I'm doing. Some of the ratios I like to look at, we have the current ratio, and I just want to make sure when I'm investing in a company that they can handle whatever debt they have. So what the current ratio does, it takes their current assets and it divides it by their current liabilities, and it just tells you that the company's, it shows the company's capability to meet their short-term obligations within a year. Anything from 1.5 to 3 is great, so they're good there. Then their long-term debt to equity, it takes their total liabilities divided by their total shareholder equity. And this kind of measures their financial leverage. And it shouldn't be above 2.0 or whatever their industry average is. So it's 0.53. And, also like when I look at these ratios, I want to make sure they're within an acceptable range. They are competing well with their competitors within their sector. I mean, one thing I like to make sure is that it's steady, their current ratio, right? So here they had a little spike for whatever reason. Maybe they just had extra debt during this year, short-term debt, but it's pretty much been steady throughout the years. And that's a good thing. So it hasn't been growing super high. They haven't had higher short-term debt. And, that's something we like to see. Okay, so looking at their debt to equity ratio, it does concern me that the amount has increased over the years. So does that mean they've had to borrow more money? Why has it increased over the years? But it was almost nothing. So I don't think it's a big deal. And it's still lower than the competition in their sector. So next we have the market cap, which tells us the total dollar market value of the company. And that's basically, you're taking the company's total outstanding shares and multiplying times the market price. So it doesn't measure the kind of like equity value or what the enterprise value of the company is, but it tells you what the price, what the people are paying for the stock. So a lot of times you want to look at the market cap and compare it to the value of the company and make sure how much are we paying to invest in this company. So next we look at the PE ratio, and it's 37, but compared to the other companies in their sector, it's fine. Then we have the PEG ratio, which is basically the P ratio divided by the annual EPS. It gives you the price of the stock, earnings per share, and expected growth. And it basically tells what they're willing to pay for the growth. So 0.5 to 1 is usually pretty good. And then anything above that might be considered a little high, but just, you're going to compare it with other companies within their sector, and they're still not doing too bad. Like if we look here, this is kind of like their average PEG ratio. It's been pretty average because it was a big spike here, and you might see like a bigger price, but on pretty much it's been the average. So now we have the price to book ratio, and this takes the market price share divided by the book value share, which the book value share is basically the net assets minus liabilities. So price to sales, it basically shows what investors are willing to pay per dollar of sale. And again, you would compare this to their sector. It's been steadily increasing over the years. So they pay dividend, which is a good thing. Their dividend per share is $1.50. Their payout is 21%. So basically, their payout ratio is taking like their total dividend amount and dividing it by net income, right? So you don't, obviously, you want to make sure a company could afford to pay their dividend and they're not using more than 40% of or whatever, or 30-something% of their revenue or free cash flow to pay out their dividend. And the dividend yield is 0.71, which that takes the annual dividend per share and it divides it by the current price. And their 5-year growth rate is 0.16. So they haven't been increasing the dividend amount by much over the last few years. Return on investment, and that's the net income. Usually they take the net income and divide the original capital cost of investment. And this kind of measures the efficiency of the actual investment. So it's a good metric. Usually for small cap companies, again, they want to compare it to your sector, but in a general rule of thumb, small cap companies, 11 to 12%. Large cap, they want to see at least 10 to 11. The S&P average has been like 8 or 9. So they just want to see that's better than that. Then the return on equity takes the net income divided by the shareholders' equity. And this measures the profitability in relation to the company's equity. So that's a good metric to have also. So you see their balance sheet in good position to pay off their debt, which is a good positive thing that you like to see. And their cash flow, which is extremely important. You want to make sure they have good cash flow. And actually, when we do our DCF, my first DCF is usually a free cash flow DCF. So look here, kind of like over the years, from 2016, 5 million cash flow, 5 billion, 8 billion, 11 billion, 12 billion, little drop here, 9, 14. Just increasing cash flow every single year. Their cash flow is increasing. And again, we look at their stock here, kind of follows the SPY, exactly like if you look at the SPY, it's almost the same way. But they've just been on an uptrend. They took this little dive here for Corona like everybody else. But it's been a steady stock. So it's had a little bit of a pullback. And I guess that's why it's caught some interest. And you see here, like at the high, the 250, this is probably in one of those metrics that we use, there was a spike in that time, and this is showing here that maybe it was overvalued at this time. So far, it is looking good. And then one thing I do like to look at is sentiment. There is some positive sentiment. And the reason, everybody has different ideas, different approaches. But I do like to look at sentiment just because, there's big money that invests in company when anything is upgraded. So, there's going to be big money that comes into that stock price, and that's going to drive the price up. So there is some inside activity. There's some no short interest. Analysts are rating it as buy. So the industry relative strength is pretty medium, pretty neutral. Okay, so if we take a look at the DCF, we have 3 assumptions. Base case is that they have 15% revenue growth year over year. Kind of just did a general 15, didn't switch it up. Because they'll have a year where they'll make 1 or 1.5 extra billion, and then the next year they'll make 1, and then the year after that is 2. So I kind of just took those averages for the base case, what it's been doing average-wise. For example, if you believe that right now they're not going to get any extra free cash flow, and they're not going to lose any free cash flow. They're just going to kind of keep the same rate that they've been keeping. You know, your intrinsic value for the free cash flow is 178. Now, worst case scenario, if they drop because of lawsuits that, you know, and controversy and people fed up with Visa, it's going to be too hard. It's too big of a machine. And Visa is like considered a duopoly with them and MasterCard. So it's going to be too difficult for them to drop 5-10% a year of free cash flow, which is not likely for the worst case scenario. But if you do believe that, then your intrinsic value 139. Now, this 18% is kind of like what they're making now. And if they keep making money with the extra services that they're profiting from, then you would give it an intrinsic value of 229, and even that is not major upside. For me, it's if you're holding it, it's a hold. You know, I would say just hold it. It's not a buy right now for me. Even if it was undervalued, for me on a personal level, I just feel like there's such a large amount of small businesses, mid-sized businesses, and even large businesses here like Kroger that want to ban Visa because the fees are just outrageous. They interviewed some small businesses and they say sometimes like right after payroll, their second biggest expense is Visa fees, which is too much. Like you have so much money, you're making a lot, find a way to make it cheaper, make these fees cheaper. They estimate that the US spent 6.7 trillion. The fees collected jumped from in 2009, they collected about 25 billion in fees, and it jumped all the way to 2019 now to 67 billion. So it's up 88%, and you know, and it still keeps going up. From a moral aspect, even if this company had the potential of making me an extra 30%, I don't think I want to invest in Visa. I don't like the aggressive fees, but they justify the fees. I've heard them justify the fees, and they mentioned that the convenience and the amount of revenue that they get from being able to process some of these transactions all over the world is access that they wouldn't have had in the past, which is true. But I think there's a middle course. I think there's a way where, okay, you guys are offering a great and amazing, life-changing service. I can travel at the end of the world in a small village in India and probably use a Visa card, which is amazing. But at what expense? There's got to be a halfway. Hey, let's meet the small businesses, medium businesses, and even the large businesses like Kroger, somewhere in the middle. So that was my take. It's no go for me, even if it dropped 50%. I don't feel comfortable investing in them. But even financially, they do seem a little bit overvalued. So I'm going to put it in my bearish overvalued folder. And that was my video. Thank you for watching. See you on the next video.